Good afternoon, ladies and gentlemen. Welcome to our webinar today. And this is one of a series of Thursday webinars that we roll out to you to keep on giving you insights and mentoring you to get better in your trading. So welcome all, and let's go through the trading of wedge structures in the market. I hope you can all hear me. Make sure you join with your audio options on, and make sure you can see my screen as well as we prepare to look into trading the wedge structure in the market. The wedges are based on support and resistance levels, and whether you can see trend lines, whether you can draw trend lines, you're pretty much sure that you understand these and you can make even better use of support resistance levels trend lines in this case. Okay, so this is going to refocus you into not only using trend lines alone, right, but seeing the structures that the market is forming, right? When you have the bounds that the price is playing by, either on the upper side or on the lower side, you see what is happening. Towards the end, we will answer your questions. So if you have anything that you'd want to understand more from this discussion that we have today, make sure you write a text and I'll see it on my end and we will answer them towards the end. So a wedge is a chart pattern, of course, when price consolidates between support and resistance lines. So it should be very easy for us to get this concept because we understand how to use support and resistance lines. Of course, we've studied this one from our previous classes. So when you see the price is consolidating, and by the term consolidating, we mean that the price is just ranging within a given bound, okay, upper bound and lower bound. It's consolidating, but as it is consolidating in such a manner that it's forming some form of a structure that looks like a wedge, right? So the trend lines form a channel like, but more of a wedge. So that wedge or that channel like form becomes like an arrow towards the end, and after that the price breaks out. So wedges can serve as either continuation or reversal patterns. That is, you've been having an uptrend, then you get into a small consolidation or a long consolidation, and then there's some formation of a wedge before the price breaks out and continues with the trend. That is one. Or a reversal pattern. Okay, you're in an uptrend, and then the price forms a wedge, consolidates there before breaking downwards and changing the trend. So these structures can be seen in any time frame, as we will see. Okay, but first, what's important is to understand how they show up in your platform. For example, look at this one here. This chart here bears the characteristics that we've mentioned there. That is the converging trend lines. You can see we have resistance levels. So this price for gold, it has been playing out. This is between August. I'm giving examples of what already happened between August and September. That is before the gold got a very nice breakout down. Once it got into a consolidation, you can see you have that resistance level there, 3 resistance points. It's a strong resistance, but trending downwards, right? But on the lower side, in as much as the price was pushing, was getting lower lows, lower highs, sorry, it was not able to make lower lows. So the price is like converging towards one end, forming a wedge, right? So the pattern of declining volume as the price progresses through the pattern. So here the volumes are going lower. The reason, the highs are forming lower highs, okay, and the lows are forming higher lows. Now there is a breakout of one of the trend lines. In this case, you can see the price broke downwards. It was a breakout downwards, and after that, it was a very nice short opportunity there. Okay, that is a wedge. Now, That is an example in the market. Let's check out on the various types that we have in the market, various types of wedges. What you need to know is understand these setups so that you look out for them there in the charts. For us who've been trading for quite some time, you just need to know how the structure comes out and you go and look for those setups exactly the same way they are, right? And here we look at the falling wedges. We have both falling wedges and rising wedges, but first let's look at the falling wedges. In this case, it is formed when the price consolidates between a downward sloping support. Check out on the reversal of our downtrend. So the price is trending downwards, and then on the support level, it is sloping downwards or descending. All right. And then after some time, of course, you realize that there is a breakout. All right. But something very notable is that the highs that are being formed in this case, we are having lower highs, but the lower lows are not are not really significant enough. Like the slope in this case, it is decreasing volumes on the upper trend line, right? So it reaches a point where the price breaks out. Still the same case on the second figure, but below it, the same case, it's a downtrend, then the price breaks above that falling wedge. Okay, so a falling wedge is where the support level is holding steadily. It's not, we don't have the slope quite steep. The upper trend line, which is the resistance, is a little bit more steep. Okay, so why have I used these two setups? Just for the same reversal of a downtrend, because I want to show you the levels where you'll be looking out to enter a trade. Check out at that point where, at this point here, where the price breaks out. The same case where the price breaks out. So there are different ways you would want to trade these setups. One of the ways is where you would want to wait for the price to break out first, leave it, and this is for a conservative trader, the one who wants to wait for confirmation. So you wait for the first breakout, right? Wait for a pullback, and on hitting that same trend line again, that's where you buy. Okay, and then you have your stop loss on the previous swing low on the support. That's where you would have your stop loss at that point. SL, just like you can see, and you can target your profits at the level of the previous of where the wedge started. Okay, that is how one way you can trade it. Another way is for the traders who are aggressive. You don't likely waiting for the confirmation, so you wait for the price to break. Once it breaks and the candlestick closes above that line, at that point there, then you buy, and of course you put your stop loss on the previous swing low. Stop loss there. What you're targeting is the starting of that wedge. That is for a reverse of our downtrend. Now, for the same falling wedge, it can occur when there is a continuation of an uptrend. So the price has been trending upwards, like you can see here. Still, the two approaches for traders, all right? Two approaches for two different traders. One will wait for the first breakout, all right, because it might be false one, okay? And then after the retest of that level again, that's why they will take the trade. Take the trade thereby, then put the stop loss at the previous support or the previous swing low there. Stop loss here, then of course that's a buy, targeting the beginning of that wedge. Okay, but in this case, if it's a continuation of a trend, then of course you might want to use a trailing stop to keep on chasing that trend, right? Another scenario is where you have a trader using a different style. Once the breakout is out, this is an aggressive trader, then they enter a trade there, but of course you have to make sure that the price has broken above, the candlestick closes above that trend line, then the stop loss on the previous swing low. Of these setups, which one I recommend? Of course, each of these can give profits, right? It depends with the style that best suits you, right? Now, this is for the falling wedges. In both cases, you can realize the wedge was being formed, but in such a way that the upper trend line, which is the resistance trend line, has got a higher steep. It has got a higher gradient, or it's a little bit steeper downwards as compared to the support level. It's because the volumes are decreasing in this case, right? And it is the selling volumes. Yeah, the sellers' volumes are getting eroded, okay, as the buying volumes are holding still. That's why you can see the setup that way. Now, let's check out on the rising wedge. For a rising wedge, it is also called an ascending wedge. It is formed when the price consolidates between an upward sloping support and the resistance lines. So in this case, you can still have a reverse of an uptrend or a continuation of a downtrend for the rising wedge setup. Okay. Now, in this case, you see that the buying volumes are getting eroded. And that's why I see that the support on the support trend line is a little bit steeper than the resistance trend line. Okay. So on the reverse of an uptrend, this is how the setup of the structure should be, so that there's a trader for a conservative trader who wants to wait for a confirmation, then they will wait for the first breakout, right, and wait for a retest. Once the price retests there, that's where they will sell and put a stop loss on the previous swing high. Where are you targeting? Previous, probably on the beginning of the wedge. The same case for the aggressive traders. Immediately you have a breakout and the candlestick closes below that trend line, then you can enter the trade, have a stop loss up there. Of course, where you're targeting the beginning of that wedge. But I will mention something when I cover all this, where you can scale out your profits. So this is a reverse of an uptrend. For a downtrend, a rising wedge can also be an opportunity to enter a trade for a continuation. Then in this case, just the same style of trading as the first one here. A trader might wait for the price to break out, and then of course wait for a retest. And after the retest, once the price approaches that level, boom, you sell and put a stop loss of the previous swing high, and then of course target your profits at the beginning of that wedge, right, on the lower side, of course. The same case for the traders who are aggressive. Once the price closes below that trend line, you enter a trade, all right, and then stop loss on the previous swing high, targeting the next level where the price got, where the wedge started, that point there. But for this rising wedge and the falling wedge, do you really have to wait up until the price reaches your target? The answer is you don't have to wait, because you want to scale out. Sometimes you want to close in your profits. So you're using your stop loss anytime that the price attains the first or the immediate resistance level for the falling wedge. At that point there, be sure to have your stop loss. You have a trailing stop, move it up to that level, all right, and you'll have closed this as your profit. Okay, in case this price pulls back, because you cannot be 100% sure. This setup that I'm giving you here is what is the structure which you should be looking at, but it doesn't actually happen like 100%, right? So you have to keep on scaling out. So whenever a certain level of profit is achieved, for example, this could be a half of the target, like 1:1, for example, right? You use a trailing stop to close in the profit which you have, and then of course If it moves all the way to your target and it hits your TP, well and good. The same case, the previous swing points or resistance levels that you get there, that's why you want to move your stop loss. It's a trailing stop, right? Move it up there, then you can close your you will have closed in your profits. Let the trade keep on moving towards the target. If it hits the target, it is hit, well and good. The same case for this other on the continuation of an uptrend. For the continuation of an uptrend, you can keep on, if the price keeps on going higher, all right, and you're in profits, you can keep on pushing your take profit even higher and higher, trailing. Sorry, your stop loss, the trailing stop even higher and higher, closing in the profits you've already made. Same case for the rising wedge. If it's a reversal and your profit has been hit, for example, on the it's half the target, you can trail your stop loss to close in that profit already, because there's a possibility of a reversal, for example, and you have profits closed in. All right, same case for all these. So trailing stop is very important even with these structures, because no one is ever 100% sure of what is likely to happen in the market. Now we had the rising wedge, the falling wedge, but still you can have a symmetrical triangle, still the same wedge, symmetrical wedges, or symmetrical triangle to get a symmetrical wedge. So in this case, if you check out, you can see it's like in between there, right? The price is oscillating in between between that level, right? Something like that. So for these, it can either work out for the continuation of an uptrend, like you can see in this case, or it can even mean the continuation of a downtrend most of the times, right? Most of the times it works for continuation trades. Okay, the symmetrical wedges will work for continuation of a trade, but again, it depends, can as well be a reversal, right? So that you're able to distinguish between rising wedge, falling wedge, and sometimes you get a symmetrical wedge. So even if you find a wedge which is not either rising or falling, it's still a wedge, only that it's symmetrical. What you're going to count on is the first side of breakout. The first side of breakout. Is it on the upper side, and has it even broken above? Has it breached the previous high point, swing high point? All right, and you might be targeting all the way at the beginning of that wedge if it has broken upwards. If it breaks downwards, of course, you said we are looking for the first breakout move. If it breaks downwards and even below the previous low of the wedge, then you're targeting the next level. All right. The higher probability wedges are the rising wedges and the falling wedges, in my opinion. But you might want to test all these and see what works for you. Let's check out on the rising wedge. This is an example of the rising wedge in the markets. You can see the support levels here, right? Support levels are such that the uptrend based on the support has got a higher gradient as compared to the resistance trend line, right? So in this case, the price broke below. This is for Euro Japanese yen, and this is between September 2020 all the way to October. This is what happened. All right, and you can see here it was quite a good break out. For the traders who wait for a retest, this is what happened. Price broke lower, went up, could not go beyond that level, and that was the entry on breaching this previous low, or maybe at this point here. Depends again. All these are entry points, right? If you are aggressive, you just enter at the beginning at the first level here, right? If you are a conservative trader, you have to wait for a retest, then you would wait for the price to test and break below the previous level. And all this, you can see, this was the beginning of that wedge, and check out there, the price was able to hit. So what I meant is, if for example you entered a trade and you're getting profits, you have your stop loss at this level, right? If you're getting profits, of course, up to this level here, you can see what happens once the price hits that level. It starts testing that support level. All right. Once it hits the other level, it starts testing. So it's always important that once that price is attained, your profits are attained, you could consider having your stop loss, move your stop loss a little bit towards the price, right? Because of course this is where you entered. So you put your stop loss there. It's a trailing stop. So all these profits, you'll have closed in all these profits, such that if this price had to go back and pull back, because it's very likely, no one is sure about this market 100%. In the event it pulls back, then of course you've got your profits closed in. But in the event it keeps on moving downwards, trending downwards, then of course you wait up until the other level is attained, right? And you can still keep on pulling the trailing stop all the way, but keep it at a safer distance to avoid being stopped out, not being stopped out, to avoid your trade being closed prematurely, and then have it proceed. Then of course, if the price trends all the way to your target level and it is hit, there you are. Then you have attained, maybe if this distance here was like, let's say 20 pips, for example, if it was 20 pips, then I've got 1:1 for another 20 pips, 1:2 for another 20 pips, 1:3 for another 20 pips. So it's like this trade attained a 1:3 risk reward ratio. All right, it's a rising wedge. That's the setup that you can try to find out in your setups. So same example, but this one was for pound USD, right? From March 2021 all the way to April, but the breakout happens around April 5th. Okay, and you can see the rising wedge, break of the trend. For the guys who want to wait for the confirmation, see what happens. Have a breakout, retest, then boom, the price pulls follows the trend again. Okay, so it depends. Again, remember scaling out. Of course, the target levels, like there where you have the previous support there, and then next you see it attained the beginning of that wedge. So it is very important to use a trailing stop where you could have your stop loss at that point, that is your SL, after having sold either at this point, sell at this point, or sell at this point. All right, and then you could, if you're using the trailing stop, it even it enables you to keep on following that trend and raking in the profits even after your target is attained. Sometimes after the price attains your target, maybe up to this point, for example, you see your target is just about to be hit, then you can even move the trailing stop all the way down to close in the profits near the take profit and leave the price to see whether it is going to keep on trading downwards. And sure, if it keeps on trading downwards, you want profits. You're a trader, so you again keep on trailing the stop. This is one way of avoiding going back into losses, because sometimes even if you're talking about these wedges, there are possibilities, because this is the market, no one knows what will happen, we just speculate. There's a possibility the price action might go and hit you, attain your first take profit, and then go back again and trade upwards. There's always that possibility, and you don't want to have wasted all these profits in between here. So that's why it's good also to use the trailing stop, and that's a very nice example of reversal, right? Using the rising wedge reversal in those two cases. Now, here's a rising wedge continuation, trade. This is for New Zealand USD. This happened for between June, right, all the way to August 2020. I'm using this example so that you can see fine setups, all right? find setups that you can always be looking out for. All right, and you see it is on a very higher time frame, that is 4 hours, but it can work on any time frame. What you need to master is how these structures form out. All right, now here you can see the lower trend line here based on the support levels has got a higher steep, and it's a rising wedge, and right on the lower support trend line it was able to break out. And I hope you're able to see what I'm explaining, that there are traders who will enter at the break of the trend line and then immediately the candlestick closes. All right, just sell at that point, right, for continuation of a downtrend. And there are others who will wait for a pullback, and after the pullback they will enter. Or still, if you're that conservative trader, you wait up until it breaks the previous low and you enter that point, right? What will happen is that the first trader, the aggressive trader who entered at point A, will have an opportunity of riding this trade for long. But for the conservative trader, of course, you're targeting a smaller amount of profits. But remember, you had to wait up until you are sure, not actually sure, you've got a high probability of where the price might be moving. All the traders, of course, it depends with your style, right? But in this case here, I would have gone with the trader who is conservative, because there is this support level, right, that was still very important. And you can see after breaking that support level, the price went down tumbling, all the way down tumbling. But in any case, even if you're seeing these wedges, you should not ignore key support levels. Okay, either case, even if you want to see this wedge that way, because it's still a wedge, right, still a wedge, you could have got the trade here. So we can have different views in the market, but remember, whatever you choose to follow, stick to it and be confident. So that's a trend continuation with a rising wedge. Now, I think I've explained most of this, how to trade a rising wedge. Make sure you identify the rising wedge. Check out on the candlestick chart patterns, and check out on the resistance and support levels. And upon switching back to candlestick mode, you will notice that the pattern will be accurately captured. Right? You can use the line chart. Can easily help you to get those levels, and then you can switch back to the candlesticks to get the setup fast. So confirm the breakout. Make sure you confirm the breakout after after identifying the wedge. Confirm the breakout and make sure you can check out the trade entry levels, right? So you get your entry after the break of the trend. After that wedge has been breached, or the break of one of the trend lines, then that's when you enter a trade. And how you confirm is you wait for a candlestick to close below. The candlestick to close below that structure, like this candlestick here, right? And then make sure you can identify the stop loss and take profit levels. So for the take profits, you can target the beginning of that wedge, or the starting point of the wedge. We've seen that this was the starting point of the wedge. That was the target there. But remember, I told you about the trailing stop to enable you even follow the trend even further. All right. And then how about the stop loss? Check out the previous swing high. This one here, the previous swing high. These are the levels you should have placed the stop loss. But even better, like in this case, you could have your stop loss at this level or even above that level, depending with whether your account allows the stop loss to play within that range. Because you have got a small account and that amount is bigger, the risk amount is bigger, you might want to consider the second option here, or the first option here, which is the best. Second option here, which is suitable for a smaller account that you don't want to suffer all this bigger loss that is added here, right? So stop loss levels there, take profit, check out where the wedge has started. That is for a rising wedge. Now, still another example for Euro Japanese yen. This is what I was talking about, scaling out. The previous support levels are very important. These levels, right? This one is too close. The first one is too close though at that point, but you can see there was some form of retesting there. The same case on that support level, there was some form of retesting, and immediately the target was achieved, the price was able to bounce back. So scaling out means, is what I was talking about. Scaling out means considering collecting your profits when those levels are achieved. And one good way, of course, after entering that short position there, is keep moving your stop loss towards the profit side, right? The profit region, profit side. Your take profit is here, but of course now you're using the stop loss. You keep on moving your stop loss lower and lower, right? Pull it lower, stop loss. Once that level is don't again bring it so close to the price. Once that level is cleared and the price is trading, it's here, and you've attained all these profits, then you can pull again your stop loss. Remember, you still have, this is your stop loss which you're using here to trail the position, but your entry is all the way up here. So all this is profit, right? All this is profit. And you're closing in that profit using the trailing stop. When I say trailing stop, I mean you're changing the stop loss. You are readjusted from there. Let's say, for example, it was here at 124.990. That's what your initial stop loss as you are placing the trade. Then all this profit was attained. You move your stop loss maybe to this level, 124.620. And then still the price keeps on trending lower, right? Maybe it's at this point here. Then you again move your stop loss maybe to 1.24.06. The thing is, don't move it so close, because remember, this price is just up and down. It can just close the trade prematurely before you reach your target. And again, the advantage I talked about, if your take profit is achieved, you can either leave the trade to hit the stop, the take profit, and you close your trade, you get satisfied, or you can keep on pulling the trailing stop, right? And if it keeps on trading or trailing lower, right, and trending downwards, you can always keep on using the trailing stop, and that is how you can follow the trend, ride a trend that way. And if you want to know how to ride a trend, use these wedge setups. Now, let's check out on the falling wedge. So again, it forms when we have a consolidation between, of course, a resistance and a support level, and the structure is such that it is a falling wedge, right? That way. Or if it's an uptrend, then you have the price moving this way, for example. It's a falling wedge, right? Can be a continuation, right? Or can be a reversal, okay? That is a falling wedge. So it consists of a series of lower highs. So the highs are forming, but anytime they are forming, they are lower. A lower high, a lower high. Series of lower highs. So each lower point should be lower than the previous low. So it can either be, mostly it's a bullish one, right? It's a bullish chart formation for the falling wedge. Yeah. For the rising wedge, it's a bearish formation. For rising wedge, it's a bearish formation. For the falling wedge, it's a bullish formation, either on a reversal, or if it's not a reversal, then it's a continuation. right? There we go. So let's check out on the structures that we have. Here is a falling wedge, and it is a reversal falling wedge. Okay, it's a reversal falling wedge. Check out here, resistance levels. Whenever you have three levels, of course, it's a major one. It's a major downtrend in this case, but the gradient is quite high. It's more sloping than the support trend line. And after the break of the upper trend line, right? Check out what happened for the aggressive traders. Once this candlestick closed here, that's where someone could buy for the aggressive traders. For the ones who want to still wait for a retest or more confirmation, you identify that level which has been, it's a resistance now turning support here, right? Price goes up, pulls back. Once it bounces off that retest, that's where you could enter the trade. And of course, target, it was hit at that point. If you had a fixed take profit, it was taken. But if you were using a trailing stop, for example, and for the aggressive traders, a trailing stop is one of your best friend. Okay, for the conservative traders, you can as well use the trailing stop, but remember you'll be entering late. So at that point there, if you're using a trailing stop, you could have been able to follow this trend all the way to the top, right? And this trend might have started a little bit earlier, like you can see there, right? But so long as you can identify the trend, the wedge, just follow it. And you can see the levels that once the resistance levels are hit, the price will always start testing those levels. Check out, once those levels are hit, the price will start testing those levels. So that your best friend, once you put your stop loss down here, SL, and the trade is playing your way, keep on moving your stop loss up to close in all this profit. The price brings up again, that level is attained, move your stop loss, trailing stop. That would be very helpful in your trading. That's one setup for falling wedge reversal set, the reversal trade. Check out here, a falling wedge continuation uptrend. Still identify resistance levels. You have a downtrend, then check out to make sure that you have a trend line on the support level such that, of course, the downtrend, the trend line on the upper side is more steep or more inclined as compared to the other one. Wait out for a breakout. Okay, after the breakout, this is where the conservative traders get the benefit of their technique, right? The price was able to break out, went back again to the line, right? That's where the traders could have entered. The conservative traders, you enter there, price goes up, comes back again. Still the conservative traders have it. All right. All right. So the best stop loss level could have been there. Stop loss. Entry, still even the aggressive traders, they all got there at the same point. All right. For the conservative trader, there are some who will wait up until the price breaks the previous swing high. Like for example, at this point, they could have entered here, suffered this loss. There are others who will still wait up until the price hits and clears that level. All in all, it's going to be conservative, right? But if you're an aggressive trader, it's also an opportunity to catch the market earlier on if it plays out your way. Then you can note this trade was able to wait even the people who were late, But check out, it's a continuation. Target was hit there, right? Advantage of the trailing stop, keep on pulling the trailing stop upwards. And once it clears this level, have your trailing stop even higher, right? So long as the price is moving higher, keep on moving it higher, and you can ride the trend for long. That is for a continuation of a falling wedge. This was in Euro USD 4 hours from May 2020 to July, right? You can check out for those setups and see. Now, a falling wedge for a reversal pattern. Here you can see support levels, right? The price was able to break above the upper trend line and boom, enter there to buy. Of course, the first target was hit there, right? And price pulled back again. It got support on this level, which was a previous resistance. You cannot ignore these levels. Resistance and support levels, you should know them very well. You cannot ignore them. And after that point, if the traders had gotten out at this point, of course, their TP hit, okay, then still you could get another trade here. Or if you're waiting for the continuation of this trend even further, for this reverse event to go further, right, might have kept on trailing the stop all the way up to get these profits here. That's what happened for pound Canadian from December, January, from the beginning of January this year. How you trade the falling wedge? First of all, make sure you can identify the wedge. Of course, drawing those support resistance levels. All right, you can change from candlestick chart to a line chart so that you can see the levels clearly, and then you can revert back to your candlestick charts. Then after drawing the wedge clearly, it will either tell you whether it's a continuation, you're looking for a continuation, or whether you how the setup is coming up, and then confirm the breakout and where you're going to put your order, where you're going to buy or sell. Make sure that your confirmation is the candlestick closes above the trend line which has been broken. Okay, that is your confirmation. Take profit and stop loss levels. I always advise traders that make sure that before you enter a trade, you know where you'll be putting your stop loss and where you'll be putting your take profit. And that is how you can easily identify whether the stop loss level is at a level that agrees with the risk that you're taking in every single trade. Even if you're getting a very nice stop loss level, you need to, and you really want to trade with a big lot, make sure that you count the risk that you're placing yourself in and readjust the lot size. You had better reduce the lot size and place the stop loss at the best level, because this is the market. It won't hold at the level that you consider best, right? It won't hold at the level that you consider best if it's not actually the best level. All right, I don't know whether you understand me there. Make sure you place the stop losses at the best levels, because the market won't readjust that. It's only you who can adjust, right? Where the support is supposed to be, that is where it's supposed to be. So if you're risking $50, for example, and that is based on maybe a 0.2 or 2 mini lots, don't stick to that, right? Make sure you can reduce the lot size to accommodate even a bigger a bigger or even more pips for the stop loss, you'll be more secure, right? You always, you're the one who can be flexible. This market is never flexible. All right. And here another example, the setup for a reversal. This is for scaling out. These are the targets. It was written anytime that level is reached, the price starts consolidating there. Check out. Sorry, that's curved. Check out these levels. Price starts consolidating. The price starts consolidating there. All right. Check out for this, the beginning of the wedge where your target was. Price starts consolidating. Okay. So you need to be aware. This is, if you know what to anticipate in the market, then you can be even more confident and you wait for the candlesticks to confirm for you, or the market setup to confirm for you. Right. And that's what we had for today. At this time, for your questions, please bring up the questions that you have, and maybe a part you would want me to repeat for the remaining few minutes. And sure, there are so many questions here. Please don't leave, right? Don't leave. Wait up until I'm able to answer your questions. How can you access the past sessions? Check out for the pre-recorded sessions, still explaining these concepts. All right, John. Is it a must for someone to place a stop loss? Well, I don't want to misadvise you. There are traders who trade without the scalpers sometimes don't use stop losses because you're placing a trade and take advantage of the fast movement of the market. But that is not a good practice. You always need to have your stop loss, because remember, this market can be irrational, by the way. All those setups that you've seen there, sometimes you might have a setup similar to what I've shown you, a very nice rising wedge waiting for a reversal, but it can behave in a very different manner. You can find a rising wedge finally leading to an uptrend or a continuation, right? That you are not expecting, or in the wrong sign that you're expecting. So, or maybe breaking out and then going back to a trend, to the other direction which you're not expecting. So this market can be irrational. The only person who is rational here is you, and you are the one who have to put in the right measures. So one of the right measures that you have to put is make sure you have a stop loss. But yes, of course, you can trade without a stop loss, but make sure you can bear the risk in case things go haywire. But my advice is always use a stop loss. How to set a trailing stop? Maybe understand it this way. A trailing stop is when you are changing your stop loss to go either on the profit side, right? So even if it's on your platform, you go and modify the stop loss to a price that is beyond your entry, all right? And it's on the profit side already. That's a trailing stop. That's what you mean by trailing stop. If it's on your laptop, you can always pull that stop loss level upwards. Is it okay to enter a trade and exit after a week or two? Yes, it's okay. So long as you're getting profit, so long as it's trending in your favor, you can always keep that trade running and running. But you know, these markets sometimes they keep on moving in cycles, uptrend, downtrend, uptrend, downtrend, right? But if you want to keep your trades open for weeks, then you need to be trading on the daily time frame and the weekly time frame, and you can monitor them there. Again, you need to have enough capital, because a 1 week pullback is not the same like hourly pullback or 4 hours pullback. So that even if sometimes you see, for us, when you're holding a trade in 15 minutes, you can wait for a pullback and still the price moves in the direction that you're expecting and you get profits. But imagine a pullback in a weekly chart or maybe a daily chart, right? It might have enough money to allow for the price to play around. But yes, you can hold position for as long as you want. So if you're holding your positions for more than maybe a week, for more than 6 days to weeks, then you are a position trader. Which time frame has the strongest trend line support resistance? Maybe consider 4 hours. 4 hours can give you good setups, but still remember you can trade even on these smaller time frames. Only that on smaller time frames the setups will appear a little bit more frequently, so you have to keep on checking out new wedges in the market. John, you wanted to see how to adjust. I think I can let me try to share out. Let me try to share out my my screen on the trading platform. Can you see my trading platform? Right? Can you see my trading platform? Yes, you can see on my demo. And actually, there is something here on 4 hours. This is US oil. Let me see whether we have a continuation here, or whether it was able to play out already. See this? You see that? Right? A falling wedge, breakout. Okay, continuation. You see that? Now let's say, for example, I enter a trade. I just want to show you how to do a trailing stop. Let's say, for example, I buy a 0.02 and I have my position there. If you can see my screen. So on your laptop, for you to place a stop loss, you just pull and you can see where the stop loss is at, right? There. Okay, it's not yet. Or I have to enable trading. You just pull and your trade is placed there. A little bit of delay. If I have to take a profit, you just pull that way. Now, how you place a trailing stop? If this price keeps on going higher and higher, you just drag your stop loss to go beyond your entry, beyond where you bought at. Pull it upwards. That's a trailing stop. So you keep on moving higher and higher and higher. But in this case, because this price has not yet moved, I cannot place the stop loss above this level. So it's just a matter of pulling it up and up, right? But beyond where you enter, that's how you place the trailing stop. But now, because the price has not yet moved in a direction, then I can't place it. It will sound invalid, right? That's how you would do it. Well, you want me to repeat about the line graph? Good. Let me show you about the line graph, right? Now you have this price here. I have to remove everything. Let me remove these moving averages, or maybe add another US oil chart. Where is the US oil? Here. Let me add a new chart. So I have this chart. It was on 4 hours. And this is where we want to identify that line chart. So that wedge. So what do? Just go and select the line chart. So the line chart can help you to identify those levels a little bit more clearer. For example, you can draw that line joining these points from here to here. That one. It's quite clear. All right. And when you check out there, you can see, well, that way there. Not the best, but it's still showing the price broke upwards, right? Maybe not the best example, but the price broke upwards, right? So using these levels, you can see, all right? And I go back to the candlesticks, see something like that, okay? If someone still wanted to see it this way, it's still valid, right? It's still valid. Maybe a new currency, which whether you can find something like that. These are line charts, but this one doesn't have any clear wedge. No clear wedge so far. Maybe at the top here, check out this. What happened? There was a falling wedge. So after identifying that way, go back to the candlesticks. Check out that. See what happened? An uptrend reversal, or could be a continuation of this downtrend here. So just practice on how best to get them, and you can see how the price went that way. All right. Hope I've answered your question, Daniel. All right. What time frame? Even on 1 hour, it can work on 4 hours, on 15 minutes. But the best is the higher time frame, the better for you. You are not able to access the past gold session. Well, I think that it was live on Facebook. All right, I think it might have been posted, Isabel. So, ladies and gentlemen, yes, Edna, you're saying that you close a trade manually using a phone. Using your phone, just click on that. If you're using the MT4, the common MT4, that blue one, right? Just click on that trade, or long press on that trade, or just click once. Right, once you click once, there's a place for you to close the trade, and then click confirm you want to close either at a profit or a loss. Right? If it's on the FXPesa app, just click it once, and there's a place for you to close the trade. All right. Thank you so much, ladies and gentlemen. It's been a very engaging session. Keep on practicing, keep on learning, practice how to draw those wedges. And let me give you this advice. There are so many ways you can trade the market. There are all sorts of indicators. There is these wedges that I've shown you. Just stick to one, master it so well, such that that one becomes your trading style, and you don't care about what others are using, right? So if it's those wedges, stick to those wedges, okay, and master them so well that that is your trading style, and that's what you see once you get into the markets, right? So you have to make a choice. You can't trade everything. You can't trade with every style. Well, it's possible, because if you learn them, you can combine all of them. But for you to be very effective, you have to choose something that is the best for you. You can't be like a master. Is it a master of all trades or a jack of all trades? You might understand all of them, but there is one that you would want to concentrate on and be the best in it. And that is the best that I advise you. Choose what is better for you, work on it, and trust in the process. You will be better. After all, everyone gets profits and losses here. What you have to make sure is that you get more profits, right? Or get more winning trades than the losing ones. Or either way, get more profits at the end of it all, so that you break even. Thank you so much. And thank you for your time to be here. Keep learning. It takes that level of interest, that level of education to understand the markets and be better. Thank you so much, and see you next Thursday. Bye.